Welcome back everyone. In this video we will study the long strangle. The simple strategy of the long strangle is built by purchasing a call and a put. As for the straddle, unlike the latter, which is made on the same strike, in case of the strangle, the strikes are far from the price of the underlying. Let's focus as always on the dark payoff at expiration date. In our example, the underlying price beats 1,000. We simulated the simultaneous purchase of a put at strike 960, which cost us $25, and a purchase of a call strike 1040 at a cost of $22. As you can see, these are two OTM strikes, as they are far out from the underlying price. The total cost of our strategy is $47, which corresponds to almost half of the points needed to open a straddle, which costs 80. In fact, compared to the long straddle, we have saved a lot of money. But clearly our savings translates into the need for the underlying to move with greater amplitude to bring this figure out of break-even. Break-evens are found at 1087, 1040 plus 47, and 913, 960 minus 47, respectively. In addition, we may profit both if the underlying reaches the sky or zero. When do we use this strategy? When we expect a rapid and directional price movement. What matters to us is a quick and deep move in prices, no matter the direction. Looking at the orange curve, we find that long strangle is also a time-sensitive strategy. The real, and only, risk for this strategy is to lose the overall premium paid for the purchase of the options. This happens when the movement of the prices is not sufficient and this move fails to offset the time decay. Therefore, the advantage is the limited risk with a lower initial cost respect to straddle and a theoretical change to make unlimited profit. Problems arise if a strong directional movement does not occur within the next days after purchase and, therefore, it is likely we lose all or part of the premium paid. Compared to the long straddle, we save some money, but the break-even and gain points of the strategy are slightly further away. To simplify, we pay less but have lower statistical probabilities. This is because everything on the stock market has a cost and nothing is given for free. Let's take a step further here too. Is it possible to be able to reduce the cost of the position? Is it possible to put a little less money in the pot and still play in both directions? Barring extreme events, the underlying is unlikely to hit 0 or 2,000. Well, yes. We can sell options at more distant strikes and with smaller deltas, creating a figure that, for a lower cost, no longer allows us unlimited gains, but a nice profit. The strike price of the options sold is our maximum target. Here's how you can significantly change the risk profile of even a long strangle, simply by selling the same amount of calls with a higher strike and puts with a lower strike, more OTM than we have purchased. In this way we can reduce the cost incurred. In this example, we buy call options at strike 1040 and put options at strike 960, paying $47 and, to decrease the cost of the position and consequently the risk, we sell a call option at strike 1100 and a put options at strike 900. This allows us to collect a total premium of $21. We can reduce the cost of this long strangle from $47 to $26, simply limiting the theoretically infinite profit potential. In this case the technical term is reverse condor. In both figures, in the face of a lower cost, it is also possible to shrink the break-even points of the strategy, passing from 1087 to 1066 and from 913 to 934. The downside of this strategy is that we now have a take profit. This profit is equal to the strike price sold minus the total premium paid. $34. Thank you for watching, see you in the next video.